Excuse me. Left, right, out. So we're left, right, and we're just out now. We're at peak euphoria. I keep saying it. It seems like it just keeps going further and further. I don't even know what is going on anymore, and the market's no real mark. It's like we can look at various things. I mean, there's always bad numbers that are coming out, like the manufacturing numbers that came out yesterday was not very good. We can look at certain weird breakdowns in the markets. We'll look at used car prices. I mean, they've exceeded the point of, the average person, or let's call it the average person, or somebody that needs a vehicle. It's really tough for them to get anything that they can actually afford. Even we're talking vehicles that are, 150K miles. Those used to be your beaters that people could just go on the lot and get, I don't know, a real basic vehicle for nothing, well, not nothing, but, a few $1,000s to like under 10 grand. You can get something that's close to 200,000 miles. That's, whatever, almost 10 years old. It's the beater. It's the one you don't want to get a loan against. You want to pay cash and run around and save money for something else. Well, you can't get those anymore, hardly. I mean, the beaters that you're getting now they're virtually ready for the crushing yard. You can't. It's hard to do what you normally would do just 5 years ago. So that, you couple that with the housing market, year over year housing prices are astronomical. We know that. But we can go into the markets itself. The reason I'm doing this one right here in this video, I'm doing something else, is if you go to an S&P 500 chart and start from, whatever, a week chart, a month chart, or go to a 3-month, 6-month. I challenge you to go to the 1, 2, 5 and all chart, where it goes back to the 80s on just your basic stock app. And just look at that and see the exponential growth curve you see on there. That's absolutely indicative of just hysteria. It looks like, if you look at the tulip bubble thing that, in Denmark, you look at any kind of huge bubble, you have this exponential growth curve and then just absolute collapse. We are on that. You don't even realize it when you look at like a 3 or 6 month chart, but when you get to the 2-year, the 5-year, and the all, and you see that curve, it's going straight up at this point. And I don't know why. I mean, nobody knows why. I guess you've pushed everybody out onto the risk curve so much with the ultra low interest rates, where they're effectively negative interest rates. I mean, maybe they've been negative real interest rates for a long time, and we're at peak negative interest rates. Which, what are you going to do now? People are literally pension funds too, even professional investors are having to chase yield. They're having to chase returns outside of safe investments, because look at the 10-year and look at the difference between a 10-year and a 30-year. You're like 1 something. Granted, the 10-year popped to 1.6 something. I mean, a huge move again. But I don't know what to tell you. But your retired investor, your guy that's living off retirement, is getting killed. And anybody that is investing, you have to go out further and further onto the risk curve. And we know how that ends. So in a real market, these things wouldn't be exacerbated to this extent. You'd have the corrections in the beginning, or whenever these inequalities are easily smelled out by the market itself and corrected. And we don't have that, because you have this backstop of the Fed put. You have the easy money. You have manipulated interest rates that are key drivers in economic actions. I mean, because these are signals, these are price signals, these are supply signals. These are, there are a number of different signals that, like, various mechanisms of supply and demand dynamic and interest rates have on these things. But it's just a weird Santa Claus rally, whatever you're gonna call it. It's just weird how this thing is just popping. But we'll see what happens. Like I said, I expect at least some kind of correction, because we'll see what the Fed does. Fed's going to continue tightening. We're going to hear from this week tightening relatively, I guess. I mean, they're going to lower how much they're going to keep injecting into the system, and then possible interest rate increase. Which, what are they going to do? Maybe a quarter point. I mean, I'd be super surprised. What they really need to do is at least they need to go above and beyond. So if we're at CPI, which we know is representing the actual rate of price increases, and we know that the inflation rate is astronomical. So in order to just combat the rising prices, so let's just even take the CPI. So it's close to 7%. You need interest rates above 7%. So I don't know how they're going to do that. They're not going to do that. I doubt they get past 1. So they hit 2.25 last before it crashed. I'd imagine they get to, at most 1.5 before they create a calamity. Once you get 1.5, then, or you have something if you get the 10-year above 2, then you have this interesting dynamic where you have to weigh the risk-reward proposition of investing in things like the NASDAQ or in the tech companies, as opposed to just parking your money in the 10-year. You start losing the marginal risk investor there. But anyway, I want to leave it here. It's just an interesting day in the markets. Like you say, like I've always said, kind of look at that 10-year, look at how this momentum is, how we're, usually you say the darkest times before the storm, and the same thing is when it comes to market crashes. Usually you have this huge spikes, capitulation is what they call it on the reverse side of things. When things go down, then you have the bump up. Well, you can have the same thing on the way up. Actually, like a capitulation of buyers, like a real swoosh of buying, and then you have a correction. I'm not saying this is the crash. We're going to have to see a huge spike in the 10-year to really see the crash, because we need that flushing out of the dollar. You need that weird capital allocation mechanism where you're like, okay, you're weighing the risk and reward of going into certain different assets. And that's what you're going to see in the 10-year. And the 10-year is moving to 1.6, but it hasn't really done that flush up where we'd see like a real actual crash. Anyway, talk to you later.